Last week, the Japanese Prime Minister Shinzo Abe announced that he was going to step down from his role owing to ill health. Last year, he became Japan's longest-serving Prime Minister, having held the office since 2012. He will remain in place until a successor is found, ensuring the continuity of his economic policy that's known as Abenomics. But what is his economic legacy? And has it been a success? That's the big conversation. When Shinzo Abe came to power in 2012, he inherited a political position that was notoriously hard to hold on to, with the post changing hands 16 times since 1990, including a one-year stint of his own from 2006. That he stayed in the post for 8 years is actually truly remarkable, with only one Prime Minister, which is Koizumi, and his 5-year period from 2001 coming anywhere close during that previous 3 decades. Abe immediately set about implementing a 3-arrow policy of monetary and fiscal stimulus, combined with structural reforms that were seen as being complementary to each other. Individually, these policies were unlikely to have succeeded, but in unison, they would have a much better chance of hitting home. Pushes for structural change had historically struggled to take hold in a country notorious for its conservatism, but the repeated cycles of failed policy and failed prime ministers had started to change popular opinion. But was Abenomics successful, and will the impact of COVID derail any of the reforms that have taken place? Abe came to power in the aftermath of the 2008 global financial crisis and the devastating earthquakes and tsunami of March 2011, an event that also triggered the Fukushima nuclear emergency. But Japan's main economy had been reeling from other economic structural headwinds long before these events took place. The equity market and property prices had moved into bubble territory in the late 1980s before imploding. Neither have recovered their former levels, and the Topix index is still over 40% below the all-time highs 30 years later. Two of the overriding issues for Japan has been her aging demographics and the use of excessive government debt to try and replenish the growth that was lost with the bursting of the bubble and its declining working-age population. Japan's government debt to GDP has soared to over 250%. But unlike other countries which have seen their ratios blowing out during the current crisis, Japan's debt ratio has been marching higher for the last 25 years. The use of increased government debt levels has been an attempt to combat a level of GDP growth that had all too frequently slipped back into negative territory. The 2020 bust is the 9th occasion since 1990 in which quarter-on-quarter GDP has dipped below zero, though this one is by far the most dramatic. However, the declining population means there are fewer workers able to contribute to GDP. Maintaining GDP growth without population growth is an uphill struggle unless there are significant improvements in productivity. Japan has seen an increase in the number of women in the workplace, but this demographic dividend is coming to an end. But Japan's households have continued to build up their savings. Japanese households are some of the biggest global creditors, influencing many different asset prices and geographies as they hunt for yield in other regions. You can see on this chart the narrow range that Japanese 10-year bond yields have been in for the last couple of decades compared to most other major economies. Other countries are now catching down to Japan, especially where demographics are now becoming a headwind, as they are in many parts of Europe. As a result of these low yields and flat yield curves, Japanese banks have also been fighting a losing battle. The ratio of the Topix Bank Index versus the broad Topix Index is close to an all-time low, having been in a fairly distinct downtrend since the early 1990s. Until Abenomics kicked in, the Japanese equity market had largely followed the fortunes of the US 10-year yield. When yields were rising, reflecting reflation and global growth, the Japanese equity market performed well. When yields were falling, Japanese equities tended to be on the back foot. US 10-year yields have been in a downward trend for most of the last 30 years. Abenomics appeared to make a clean break from this pattern, signalling a policy in which Japanese domestic policies rather than global growth trends could take control. On the face of it, it looks like Abenomics helped with the equity market out of its never-ending slump. For a while, Japanese equities also outperformed in local terms the US equity market, although the global manufacturing slumps of 2015 and 2018 again took a greater toll on Japan's industrial base. The S&P has once again left Japan behind, but this is more a reflection of the US equity market rather than on Japan. But Japan's equity market is cheap on many metrics, and Warren Buffett thinks so as well, recently investing $6 billion in trading houses that will also benefit from inflation. The move in the equity market was initially spurred by a policy that would weaken the yen, pushing US dollar yen higher, although explicit FX intervention had to be avoided. At the time, US dollar yen had been carving out a 3-year reverse head and shoulders formation, which provided a great technical backdrop to support a significant move on the back of a massive policy change. But what were some of the main tools at policymakers' disposal? Japan's debt to GDP ratio continued to expand, though at a slower pace than during many of the previous 10 years. Fiscal tools such as government expenditure had been of primary importance prior to Abenomics. Now it would be monetary that would go into overdrive, with the Bank of Japan balance sheet expanding at an impressive pace, largely because interest rates had already hit to rock bottom levels in the immediate aftermath of the bursting of the equity and property bubbles in early 1990s. Interest rates would be cut again, but it was the size and speed of the balance sheet expansion used to fund purchases of bonds and ETFs that really catches the eye. The recent expansion of the Fed's balance sheet in terms of absolute size is a talking point behind the recent weakness in the US dollar. But the Bank of Japan balance sheet as a percentage of GDP is far in excess of that of the US. The ratio beats both the ECB and the Fed by a considerable margin. The Bank of Japan has also implemented yield curve control, but in this instance it's to stop yields falling too low and impairing commercial banks' earnings even more than they were already, rather than to stop yields rising too far and impacting the ability of the government to pay interest on its debt. Although they will be extremely sensitive to that possibility. The Bank of Japan has already bought a significant proportion of the government's bonds in circulation. One of the stated aims of the 3 hours policy was to raise levels of inflation. In the aftermath of Abenomics, there has been some limited success in raising the rate of inflation, and overall levels have been slightly higher in the last couple of years than they were in the period from 2000 to 2010. But no one could claim that the policy has been giving a lasting effect on inflation. Demographics remain a major headwind, and apart from the unlikely event that Japan changes its immigration policy, inflation looks like it will remain subdued unless the US administration can create global reflation in its truest sense. One area in which it could be argued that Abenomics has had notable success is the decline in unemployment, though this trend was already in place coming off a high base after the great financial crash of 2008. Even after the recent pandemic-induced spike, the unemployment rate is still only around 3%. These job losses, like in many other parts of the developed world, are largely in the hospitality and leisure industries and will be reliant on the speed with which people feel comfortable returning to former levels of entertainment. Perhaps a clearer sign of Abe's structural reforms is the reversal of years and years of rising inactivity, i.e. the number of people not in the workforce. Abe encouraged women into the workforce, though the benefits of this policy have already played out. Japan has also seen cultural shifts taking place, with long hours and jobs for life replaced with a more dynamic and vibrant economy, with technology becoming increasingly important in maintaining productivity levels, even whilst the working population age has declined. Japan's consumer sensitivity has mainly come from changes in the level of the sales tax. Every now and again, Japan's administration tries to recoup some of the fiscal outlays of the previous decades. Each time the sales tax rises, Japan's household expenditures dip, and this puts pressure on GDP. The Abe administration attempted this on a couple of occasions, and the outcome was the same. A pressing issue was always the government's expenditure, and especially the net interest payments. A country which needs to raise debt in order to pay for interest payments on existing debt is usually in a perilous position. Japan's position under Abe has improved and are currently close to their lowest levels in 40 years. But that is as much to do with the global decline in bond yields rather than any specific policy within Abenomics. And in many ways, the global growth picture has been at the heart of the success or failure of Abenomics. Abe certainly did change the rigid structure of Japan's formal employment economy, instilling a level of workplace dynamism that would have been at odds with the glacial changes that underpinned much of corporate Japan in the post-war years. However, all that Abenomics can do is temper the demographic trends and not reverse them. The key one is the demographics where people aged over 64, the green shaded area, have continued to rapidly increase, whilst the population aged under 15 has generally been falling. The birth-death ratio is unlikely to tick through the magical 2.1 level anytime soon. Abe's successor will inherit these structural impediments and will no doubt continue the monetary and fiscal policies that he or she inherits. It's difficult to see how Japan can wean itself off a monetary policy that appears intent on buying up all the listed securities available within Japan. The US and Europe have been watching Japan with interest. Global yields have converged lower towards those of Japan, and those developing market blocs are pursuing even larger levels of monetary and fiscal intervention. Abe's legacy was one of structural reform, but was also one of supercharged fiscal and monetary expansion. If Abenomics had failed, the global march to modern monetary theory might have been checked. But the mild successes of Abenomics has emboldened global policymakers to follow down that path that was blazed by Shinzo Abe and his economics team. The US equity market is displaying some incredibly unusual features at the moment, and the difficulty for investors is working out what are the key drivers at any one time. We've outlined on previous occasions that this is a market driven by flows and not fundamentals. Last year we asked whether valuations still matter, and earlier this year we talked about how high equity prices do not equate to a bubble unless they're also associated with heightened emotions. Today we have a large number of technical factors that are screaming for a reversal. Now that doesn't mean it's necessarily going to be a major pullback, one that's a big bear market, but it does increase the asymmetric risk of a downside air pocket. Last week we looked at how the data usage across the Refinitiv Icon platform had fallen far more than we would usually expect even at this time of year. It's not just that traders are sitting on the sidelines, it's that they're sitting at the beach and have an extended period of market fatigue. Last week we also looked at the very unusual divergence between the S&P 500 and the VIX. It's rare but not unheard of for the S&P 500 to make new all-time highs, whilst the VIX, which is the implied volatility of the index, or what people are actually willing to pay for options, is increasing. But not only is the VIX going up today, but it's doing so at a time when the S&P itself is grinding out new highs with a very low level of realized volatility. And realized volatility is the actual or historical volatility of the index. 30-day realized volatility is at 10, while spot VIX is at 26. If you wanted to buy protection, you would effectively be overpaying for it. Very few people are buying protection. If people are pricing for US election risk, it appears they're more worried about a breakout to the upside than a breakdown. In fact, what has been happening is that people are buying call options minus put options, as a percentage of the New York Stock Exchange overall volume have skyrocketed to the highest level ever. The maturity or time left before these options expire on the largest 100 names of the S&P 500 have been averaging about 2 weeks. This is on the single stock options. So these are short-term positions looking for a quick buck. We saw a spike into the VIX in the dot-com S&P 500 peak in 2000. And we also won just prior to Volmageddon in 2018. This was February 2018, when we'd also seen call volatility on the increase. So do measures such as these now matter far more than investor sentiment, because the investors who participate in the surveys are the active investors who are being increasingly sidelined by the rise of rules-based investing, where market capitalization, volatility, and momentum are more important than earnings. S&P profits have been flatlining for 5 years, even as the index soars to a new all-time high. And the phrase "this time is different" is a much maligned saying because excesses tend to unwind. But what if the full cycle time frame consists of a very long-term investment cycle? For the last 5 years at least, this time has been different, and it may continue to do so for another few years for all we know. Price earnings and earnings per share have had little to do with large cap investing over this period. US value stocks have been lagging growth for years, but this has taken on a supercharged quality over the last 6 months, in a trend that started even before the COVID pandemic took hold, picking up with the Fed's repo efforts from October of last year. But what is growth versus value? Well, tech is growth and banks are value, and you can see that same trend in the performance of the ratio between the Nasdaq 100, which is tech heavy, and the US Banks Index, the BKX. The biggest stocks have been getting much bigger at a much faster pace than the smaller cap names, particularly in the tech space. Apple alone at 2 trillion is about the same size as the whole of the Russell 2000 small cap index. Although the market cap and the earnings of tech and communication sectors within the S&P both equal around about 40% of the index. It's just that these sectors have been increasingly concentrated into a few hands. And this large cap effect is even clearer when we view the US discretionary sectors, where the automobile sector looks like a standout performer. However, this is nearly all Tesla. The rest of the sector is comprised of the usual dullards of the auto industry. This trend in concentration and acceleration shows no signs of abating. Most people will also now be familiar with the influx of retail investors, not just in the US market, but globally, including Brazil and many parts of Asia, who have also jumped onto many of these trends. Have they piled in sufficient quantities to create the emotional froth that normally accompanies a major market bubble? Are institutional investors still suffering the ill effects of the pandemic period? It would appear in many quarters that they have also regained some of their animal spirits. The National Association of Active Investment Managers Exposure Index has returned to the all-time highs, and this has been coincident with prior market peaks, but there have also been similar readings during periods where the S&P 500 continued to march higher. JP Morgan have also recently suggested that asset managers are around 41% equity in balanced funds. This is where you have both bonds and equities, versus closer to 49% at the peaks, suggesting there is still more room to add equity and push prices higher. The Reuters asset allocation poll also shows equity holdings are well below their peaks within balanced funds at around 43% versus those peaks close to 50%. While some of the active manager survey still suggests there's room for upside, lots of shorter-term technical indicators, driven by emotion, suggest that the market is massively overbought. The S&P 500 is banging up against a medium-term trend line, which would once have been a catalyst for many technically minded asset managers to start reducing some of their equity exposure. But this group of investors are no longer in the driving seat. Share buybacks in tech stocks, shadow banks leveraging commercial banks' balance sheets for high-frequency trading, and retail investors using short-dated options for leveraged plays on single stocks are some of the main protagonists in a market which currently has much lower volumes than the late summer usually experiences. But the framework is still in place for a short, sharp pullback. Volatility is pushing higher, though it's the realized and not the implied levels that matter for most rules-based funds. Hedging costs are increasing whilst the cost of long call positions, this is in options, is reducing the likely chance of a positive return. Perhaps more worryingly is the likelihood that as markets continue to rise, the need for more policy intervention reduces. This market likes liquidity, and the best way of getting that is if the equity market undergoes a short, sharp correction that kickstarts the Senate's fiscal negotiations and gives the Fed another green light to find yet more assets to buy under their QE Infinity program. When we were filming in London's financial district a couple of months ago, it was abundantly clear that the majority of workers had remained at home even after lockdown measures were eased. Many estimates suggested that the number of financial workers who had returned could be as few as 15% of the total workforce. It was also clear that back-to-work trends in other UK regions were much stronger, especially where the urban centres were less crowded in the first place. Now that we are coming to the end of the vacation period in the Northern Hemisphere, there's been a lot of discussion about peak work from home and the expectation that workers will now start to return to the office. Andrea Stone of Refinitiv looks at the work from home data usage and how return to work trends are differing by region.
Is the rise of working from home a permanent phenomenon for financial markets? With COVID, we've all had to shift our balance of working in the office to working from home. We wanted to take a look at that picture and see if there was any variance by country or by job type. Would this show us nations' collective attitudes around the response to COVID and the return to work? We took a look at our customer usage patterns with a very simple hypothesis. If you were logging on to the desktop, you were most likely in the office. And if you were logging on to Icon Web, you were most likely at home. We then compared that to geolocation data from Google and found some interesting trends. Here in red, you can see Google's data on commuting levels in India. And in blue, moving in the other direction, Icon users logons via the web. Globally, the picture is clear. Web logons as a proportion of total logons rose 600 basis points in the first 3 months, and they are still far higher than they were in 2019. Country by country, there's far more nuance. You can see that in the UK, the initial jump in web usage and that real stickiness in that number even as corona cases have fallen. By contrast, users in France, Italy, Spain, and Germany are slowly drifting back to the office. The question for France and Spain in particular is whether that trend continues as cases spike again or have attitudes relaxed. We'll be watching these numbers in the upcoming weeks. Hong Kong is interesting with 2 increases in home logins, one in February and a second in July, as cases have resurged in recent weeks. The other interesting trend is among users in Brazil, Russia, and India, who appear to have gone into lockdown well ahead of the actual virus threat. As for the US, web usage has climbed about 500 basis points from a pretty high base before the crisis and has broadly remained there irrespective of infection levels. So what do these country snapshots tell us? The decision to work from home, it's probably more to do with local conditions, local infection rates, local lockdowns, local attitudes, than it is to do with the job role you perform. Whether it's trading, M&A, asset management, wealth management, risk, middle office, or back office, our data shows very little variation in how job roles have responded to the COVID crisis. It looks like what we're seeing is a slow and cautious attitude in the return to the office, but it is happening gradually. We'll get a firmer view on how the markets will get back to business, most likely after the US completes its Labor Day holiday. We'll let you know what the data shows us.
It's clear that the work from home mentality kicked into gear even before some of the lockdowns were imposed. Regions where transport networks are crowded, such as the City of London, also appear to be showing a greater reluctance to return to the workplace. And the government in the UK is now having to tackle this reluctance head on. We should also expect workers to drift back to the office from now, but it's clear that the impact of COVID-19 has allowed a re-evaluation of that workplace. How emphatic that return will be will probably become clear over the next few months, during the September to mid-December period, which is usually one of the busiest times for financial markets. And you can now get the big conversations from Refinitiv as a flash update on your Alexa device or Google Assistant. And if you want to know more about how to download it to your smart speaker, please go to refinitiv.com/flash briefing.